Right, let's start. Welcome back. Right, today we carry on with the financial markets, of course. In the first lecture we looked at some basic principles of the financial markets, and we started looking at the bond market, and we did say that the main focus of this lecture will be the bond market and the money markets, only because we look at monetary policy, and monetary policy uses the safe assets, bonds and money. Right, so today we continue with the bond markets and we focus on the term structure. Please.
Sorry, do you have a microphone or something? It's kind of hard to hear you.
You cannot hear me?
Not that well.
No, not that well. I've got a microphone here, but I can't shout anymore. Who cannot hear me back there? Can you hear me? You can hear me. Can you hear me there? You can hear me. So those who cannot hear very well, can you move forward a bit because I can't shout? I mean, the thing is this, we have no, let me just check something. I don't know if you can hear me better now, but that is max, really. It was on 90%, I'll just put it on 100. So, I was saying that we're going to continue with the bond markets and we're going to look at the term structure of interest rates, or just the term structure as we call it. And as you can guess, the term structure has to do with the structure of different bonds of different maturity and how the interest rates are related. So basically, let me just put this on view. Reading, right, it's better. Okay, so basically the term structure of interest rates, or the term structure as we said, is the relation between the yield to maturity, which we discussed in classes, and I've got one more this Friday, today, and the term to maturity. So basically, it's a snapshot. It's a snapshot. If I open the financial pages and I look at bonds of different maturities, could be the 2, the 5, the 10 year, and then the different yields that are offered on these bonds, and I plot them, I get the yield to maturity. It's as simple as that. So it's a snapshot. And the reason why I'm saying it's a snapshot, it's because it can vary from one day to another. So if I look at the same structure of bonds of these maturities, tomorrow, the yield curve may look different. And I'll explain today the reasons why. By the way, I've got a code down here for you, right? So, let's have a look. We said the yield curve will plot yields to maturity against maturity. So here's an example. This is one I made earlier, as to say. And it's from the Financial Times, 1st of March, 96. Particularly, okay, this is not exactly a bond, but it's very related. It's certificate of deposit, which is very similar. It's like fixed term income savings assets. But let's have a look. I'm going to stop at 12 months. And what I get is that for 1 month, they offer 6.25. For the 3 month, 6.125. The 6 month, which is half a year, 6.06. And the 12 month, the year one, it's 6.125 again. So basically, if you plot these, this is the 1 month, 3 month, 6 month, 12 month. If you plot these, you get the yield curve. So it's as simple as that. And why do I say it's a snapshot? I repeat, because if I look at the same yield tomorrow, it may be different. As new information comes in about what's going to happen to the economy, expect inflation, recessions, macro policy, etc., we'll discuss that. Now, what's unusual about this yield curve, those who've done classes with me, is that one of the questions was the yield curves are usually, and the answer was upward sloping, smoothly upward sloping. And why is that? Because you expect to be offered a high interest rate and therefore a higher yield for longer maturities to account for the risk of the future, right? I mean, if I say to you, offer me your money and I'll give you a bond for 1 year, you would expect if I say, give me your money and I'll give you a bond of 10 years and you'll get your money back in 10 years, you would expect the 10-year to offer more as an interest rate, a high interest rate, to account for risk. Anything which is less liquid, basically, should offer a high interest rate. And this is why we expect this to be upward smoothly upward sloping. Now, looking at this, that's nothing like it, right? Because you can see it's inversely related. It's going down, and then it's picking up a little bit. So is this an unusual yield curve? The answer is not really. What matters here is that this is a 12-month period I'm looking at, and bonds will run to 50 years or more. Therefore, it's just a snapshot, but not just a snapshot of this particular asset, a snapshot only up to 1 year what's happening. And it's not uncommon to see the rates vary in the very short run, that we have more information, than in the future that we don't know what happens. In the 20, 30, 40 years from now, you would expect the rates to be high again. So let's see. What I'll do next is I'm going to take a different example, which is only 10 days later. Okay, let me just see. I'm going to take this example here. This is from the Financial Times. 10 days later, yeah? 11th of March, 96. And what it gives you, my God, I need glasses even from here, I can't see this. So it's not very clear, but there you go. It's a picture from the Financial Times. So what you see here is a month ago. Remember, we said they're snapshots. So if I look at it today, for example, actually it's not today. That was published in the Financial Times on the 11th of March. But if you read here where it says it's the 8th of March. It's the 8th of March, 96. So that's the black line here. And if you look at the same structure, a month ago, it's the white line. So obviously it shifted up, right? Within a month. Okay. And then I have here, they're called benchmark yields, yield curves, because they're looking at the 10-year bonds, which is the benchmark bond, right? The 10-year. So you can see that they're slightly different for London, New York, and Frankfurt. I mean, looking at this, the first thing you observe is, okay, well, in the US, it shifts up completely, but quite a lot. In London, it just crosses a little bit here. Can you see that? The black line goes, it's quite steep. In fact, if you look at the London one, for the UK 10-year bond market, it's steeper than the other two. Is this a good thing or a bad thing? We don't know. I'll tell you how economists interpret these things. And then you can see that Frankfurt is more or less unshaken. Okay, the only thing is that the black line, which is now, as opposed to a month ago, goes a little bit more optimistic. In other words, it goes above the white line gently. So looking at this, there's many different ways you can interpret this. And this is why I want you to be very careful here. For example, the book will say that usually that depicts this information. Well, it's not just that. It depicts, it could depict, it could reflect on many different pieces of information. And this is what we want to cover, just outside the box a little bit. So, yes, the obvious thing that it picks up is what's going to happen to economic activity. Why?
What's going to happen to?
Economic activity. Right? Why is that? Because if economic activity picks up, then what happens to the interest rates? Are they going to go up or down? They're going to go up, of course. And of course, what do you expect inflation to do if economic activity picks up? Does it go down or up? It goes up again. Good. Therefore, we agree that economic activity heats up the economy. I don't want to say overheats the economy, but it heats up the economy. Inflation prices will be going up. But I know that when economic activity, inflation goes up, interest rates will be going up. Therefore, the fact that I'm looking at this and it's upward sloping, it means a number of things. The first one, as I said, is you account for liquidity and risk. Therefore, the higher maturities, if you look at here, for example, the 10-year, the 20-year, the 30-year, offers a higher return on average, a high yield. But again, you may say, but looking at these three, they're completely different things. I mean, within a month, their shape is very different. So it can't be just they're picking up liquidity. Liquidity should be the same, more or less. So what is it that they're picking up? It's basically information that comes in about economic activity and inflation. So if you focus a little bit on here, can you see what happens here? Up to 1 year, it dips down. Can you see that? It's going down. And then it goes up a bit. Well, this is exactly what this here shows me. Because these are, again, the UK markets up to 1 year. And what you see there, that little small dip and up again, it's in here. I mean, 10 days later, that has not changed. There it is. This is what we're looking at. But now you're looking at the whole picture up to 50 years, let's say. And you can see first it goes down, and then it goes up. So the idea here is this, that a number of countries were facing a little bit of recession at the time. So they expected the rates to drop. Not so much about Germany, but definitely if you look a month ago in the US, can you see that? And the UK, they definitely dip down and then they go up. Now, you may say, okay, so I get this. So something happened and economic activity is picking up and therefore they start offering high interest rates. Exactly. I mean, the thing is this then. Why is it that the US is making this big jump here as opposed to the UK or Germany? Well, if you read the small writing, if you can read that, it says that the US, okay, investors have been, let me just put my glasses, it's so hard to read this. Okay, so it says here, and I'm sorry about the quality of the print, but it says today we'll be anxious, blah, blah. The Federal Reserve would move to cut interest rates. So they thought that because recession was still on, that the US would move in and cut interest rates. If that's what we expect, then you're looking at this here. But then it says a report came out, right? that was surprisingly positive because it showed strong employment. In other words, that employment is getting higher, a sign of economic activity. So the revised yield doesn't have that dip anymore. Can you see that? You expect interest rates to be going up. Look, we're not in recession. The reports came out. GDP is going up. Employment is going up. I have no reason to drop the interest rates. Therefore, the minute that comes out, there's a shift here upwards. Now, the same happens in the UK, you could say. But I want you to be very careful, because in economics, I'll be very honest with you. How can I put it nicely? Nothing is certain. It's not physics. I hope you understand what I'm saying. Right? I mean, with physics, you know what happens. If you put so much pressure on a can, it will explode. You know exactly when it explodes, given the material quality of it. Economics is not like that. I mean, somebody looking at this may say, yeah, I've got all the theories behind it. But, you know, the UK could be also, because it's the biggest competitor to UK government bonds is the US market for bonds. Therefore, they see what's happening in the US and they adjust what they offer on the UK bonds respectively. So I'm not looking out for necessarily a report here. Of course, you may say, this is what the government will offer on the 2, the 3, the 4 year, but at the end of the day, it will be the demand and supply of bonds that will determine the final price and therefore the final yield. So, the other thing is that, look at that. I mean, am I right that if you look at this, you've got a 10-year bond. Let's take the 10-year. So it's here. The 10-year today offers something about 8% in the UK. In the US, it's about 6.40, roughly. I mean, we don't care. And in Germany, the 10-year is about 6.5. So here's another question. Why? Why do you think? I mean, again, you've got to look at the economy and what's happening at the time. We know one thing for sure, that investors want to see a higher yield to be happy to hold a UK bond as opposed to a German bond or a US bond. I'm not suggesting that it's less credible, but it's definitely, there's a high demand for the US and the German at the time. Therefore, to make it attractive, the government will offer higher interest rates to make it competitive to the German and the US bond market. Fine. The other thing is that the slope is very different. I mean, the US looks like normal. This is what annoys me about the US. Everything looks normal. Up to now, at least. Anyway, so everything looks normal. So you can see, for example, that this is what you would expect from yields, right? You would expect a shift of the whole line up. But when you look at the UK and the Bundesbank, for example, you can see that they're crossing, and then the UK rises much steeper than any of the other two, right? Which means either they think their economic activity is going to be so much higher than the rest, or they're trying to take opportunity to say, look, I'm going to make mine a little bit more attractive because I know I'm competing with the German and the US government here, and I'm going to offer on every rate a higher rate. And that's why you get the steeper line. So there's a lot of information, and I hope you understand what I'm saying here, but nothing is certain of why this is happening. So this is why yield curves have fascinated economists and financial economists and microeconomists like myself for years. I mean, there's so much information, but you've got to read the news. You've got to know what's happening. You've got to know, we'll see a number of cases here, and I hope you will get a lot out of this, which probably is not in the book. So, right, I'm going to skip that. Okay, I mean, what I will say next then is this. I'm going to skip some more examples and I'll move to something else. That the shape of the yield curve will be subject to a number of factors. And as I said, if you look carefully in the book, the main textbook, it will suggest that it's usually picking up inflation or economic activity. But I will say that there's much more to it. It's picking up a lot of things like competitiveness, risk, convergence, you name it. And let's look at some unusual curves for me to make this point. And that's what I want to do next. So, I'm going to look at government bonds. This is from Bloomberg, Sunday, 4th of March, 2001. And you get, I'm going to focus on just these 5 there. Basically, France, Germany, Italy, UK, and the US. And what you observe, that within a year from now, the French one is going towards a 4.5 rate for the 1 year. The German one, again, drops from 4.7 down to 4.5 again. The Italian one is coming from below, and it stabilizes around 4.5, but then I don't know why it's 4.4 here. It's just below the 4.5 mark. And then you've got the UK. We don't have the whole picture in the UK. And then the US, it's around the 4.47. Now, you may say, oh, this is just a coincidence. I mean, you look at this and, okay, so France, Germany, Italy, they're trying to converge the two from above, the others from below. They're trying to converge to the 4.5 within a year from now. Now, stop and think what's happening. We're looking at 4th of March 2001. Okay? What happened in January 1st of January 2002? The launch of the Eurozone. So you may say, this is a coincidence, you know. Well, I'm telling you, it's not a coincidence. Because if you look at other European countries, they're trying to converge to around 4.5, all of them. They know from officially, I mean, well, the launch of the euro was back in 1999, of course, but the official launch, it was, I mean, the electronic launch, yeah, was back in 1999, but the official euro was launched in the 1st January of 2002. So it's not a coincidence that all countries, the governments want to offer the same rate from the day they claim they have one currency and one monetary policy. It's not coincidence, right? Good. Let's look at the US a little bit. What's happening in the US? This is again from Bloomberg. The US, what you've looked at up to now is this, that it goes down, then it stabilizes, it gets flat here, and then it goes up, as you would expect it to be. Again, that's an indication of potential recession. And if you read carefully what was happening at the time, let me just see what was happening at the time, so I don't tell you any misinformation. Oh yes, Greenspan. Do you remember this guy? It was the governor of the US Fed. At the time was saying that the country is going to continue into a recession. Therefore, you can see why the rates are dropping, or what they offer, for example, the 3-month up to 1 year. But then he introduced a number of tax cuts. That's the solution of things in the US, tax cuts. And in fact, Greenspan said that the tax cuts would help the economy recover much faster, and he expects the economy to be out of the recession within 1 year or so. And again, this is what's picking up here. The government tells them, you know what, we're still into recession, but give it a year, I expect the economy to pick up. Now, the markets understand, right, within a year from now, the rates will be going up. Right, because you keep dropping the interest rates when there's a recession, but when the economy is picking up, obviously, you will want to put the interest rates higher. And again, this is reflected in the yield curve. But let me just take you to something closer to Europe. And this is what happened with the financial crisis. Actually, the whole thing started in the US. But let's have a look. Let's look at the next one. There's a reason why I picked these two dates. Okay? The first one is February 1, 2008. In other words, this is the date just before Europe is hit by the global financial crisis. And the second date, January the 5th, 2015, is just before Mario Draghi announced that they're going to go for QE because the Eurozone was in a crisis. And you can see Greece's, for example, rate here is massive. And let me just explain this. So you're looking at before the global financial crisis, the countries in bold are the Eurozone countries. And you can see against the Bundesbond, for example, which is the German. So this is the benchmark here, that's why it's 0 here, the spread. But against the Bund, the German bond, you can see that there's hardly any difference between all the Eurozone countries. Can you see that? I mean, we're talking Greece, since I mentioned it, it's 0.36, Italy's 0.37, they're less than 0.4 or less than 0.5% apart. And for many years since the launch, because this is 2008, for 6-7 years, that was the case. They converged to one rate, and then they stayed there until the financial crisis, split them completely. And of course, if you look now what's happening following the crisis, well, if you look at the spreads here, they're massive. Obviously, this is 0 for Germany because it's against Germany, but if you can see Greece, for example, it's 9.13%, which is a lot. But I want to say something because I think we should look at this. I think we're all interested in this. I mean, the global financial crisis and the Eurozone crisis was a big thing. Let me just remind everyone, because I mean, this is your generation. You'll probably remember this, or if not, I'm sure your parents would. It all starts from the US with the house market crisis. You know that. The first countries that were affected were not actually Greece and Italy, were countries that relied a lot on housing construction, like Ireland, for example, Spain, Portugal. So if I went and picked another date here, instead of the 2015, which is the Eurozone crisis, with Greece saying, hey, look, we might default and leave, if I picked 2012, for example, or 10, you would see the Irish spread or the Spanish being very high. So we will look at this in a more analytical way when we look at the global financial crisis in a later lecture. And I will probably invite somebody to give you a talk as well from the financial markets on this. So, but of course, the Irish, Spanish, Portuguese sort of crisis, or of the housing market sort of crisis, was not really, it was very severe, but it didn't affect the whole world. Unlike the Eurozone crisis in Greece, I mean, at the time, both Europe and the US were sitting on a lot of Greek government bonds. And that affected, with shockwaves, the whole world. And that's why I'm focusing on this, right? But we'll come back and talk about Ireland. I mean, the thing is this. I think what I'm trying to say here is, if you look at the spreads during convergence and no shocks, there's hardly any. If you look now at the spreads during the house market crisis or during the Eurozone crisis I've got there, the spreads are massive for some countries, right? So why does that matter? It matters because it shows that some countries will benefit from the crisis, like Germany, others will suffer, like Ireland, Spain, Portugal, Greece. And of course, this is what the problem now is. In the UK and the US, at the time, by 2008 in other words, you know what we were doing here? Do you remember? Massive QE. Massive quantitative easing to help the economy come out of the crisis. In the US, it was the same thing. They were using QE. And they came out of the crisis way, way, way before Europe. Because in Europe, you had Germany who basically didn't want to use QE. I remember Schäuble, for example, at the time was saying, what is QE? Is that inflation, printing money? Well, it never caused inflation in the UK or the US. Why? Because, you know, the German school, having suffered a hyperinflation, are very cautious about inflation. In the rest of the world that we believe in Keynesian economics, let's say, we know that if you spend during recessions, during wars like we saw with Milton Keynes, for example, there is no inflation. You're just boosting the economy. And QE was boosting the economy during a massive recession. But this inactivity, I mean, we're looking at these spreads that lasted for years and years and years as US and UK were coming out of the crisis. It shows also the complete inactivity and inability of the Eurozone to deal with the crisis. And of course, you know what happens. I mean, some of you will be doing PPE here, politics as well, you know. You know what happens when there is a mess in the economy, some politicians will use that as an opportunity to do the propaganda. And this is why 5 years later, for example, we had Brexit. Because you could see the mess in Europe, it was a good opportunity for the UK to come out. So what happens in a sort of very, very brief story, because as I said, we can spend days and days on this. It was 2015, shortly after that, that Mario Draghi, who was the president of the European Central Bank, decided that enough is enough. He pushed the German dissatisfaction on the side, and the European Central Bank started launching a massive scale QE. Approximately 7 or 8 years later, the US and the UK did that. What happened? Well, what happened was within a year of the QE, the financial markets had been appeased. We didn't hear about a crisis anymore. And there was no inflation. Right? And if you look, for example, 2021, you can see, for example, here, where are we now? Germany was Germany here. Okay. Yes, I mean, you have Greece down to 1.3%, a yield of 1.35, Italy about 1, and then if you carry on, you will see that if you come, for example, to today, if you can read this, you will see today, I mean that was last year, this year it's even lower, you will see the difference between the German and the Greek bonds, for example. Well, it's about 1% really. Italy is about 1.60 around, which means what? You know, past the financial crisis, the European countries started converging, the bond market started converging again, which meant that looking at the spreads, looking at the yield curves and looking at the bonds, you have so much information of what's happening, you know, even within the Eurozone in terms of convergence. So as I said, it's not all about economic activity, it's about risk, it's about convergence, it's about so many things. So, for example, today, believe it or not, at 1.8 or 1.5 for Italy, well, Portugal is a bit higher than that, but that is probably more attractive to hold a Greek government bond than a UK government bond right now. I mean, the investors are happier to receive a low interest rate from a Greek government bond than a UK government bond. So you can see that there's so much information now in there. What I want to do next is say something about else, which is mentioned in the book, by the way, but which is not something we're going to cover in detail, and this is government bonds versus corporate bonds. Which one is more risky? Corporate bonds, of course, yeah? So if you look at corporate bonds, which is, this is rated by Standard & Poor's thing, BAA, which is the lowest sort of form of investment. So if you look at the corporate bonds ranked BAA, you will see that they have to offer a much higher rate than the red line, which is long-term government bonds in the US, and an even higher spread between the T-bills, in other words, very short bills, which are more liquid. That all makes sense, right? You can see that the blue line is more liquid than the red. Why? Because these are bills and these are bonds. Therefore, traditionally you would like to see a lower yield for the more liquid asset, which is the blue line, than the red line. But you want to see a much higher yield for the corporate bonds, which is more risky. But notice this, which is quite interesting, that as you enter the crisis around here, for example, and later on COVID-19, 20, can you see what happens? That spread between corporate bonds and government bonds becomes very large. And this is what I was saying to some classes. I mean, we still have one later on today, but this is what I was saying, that in times of uncertainty and financial crisis, there's a switch from corporate bonds to government bonds. People want to hold something safer, and we'll explain that in the class if we haven't done it already. So this is what happens. This is what happens. If you start initially from this point here, and this is a corporate bond, this is a government bill or a bond, what happens is that as people start dropping their demand for corporate bonds because they find them more risky, they will increase their demand for the safe asset, which is government bonds. So on the one hand, you will see a drop in the demand for corporate bonds, their price will go down, the required interest yield will go up, and that's why you get what you get. Whereas here, the high demand, this demand here will go here to the safe assets, which are government bonds. Their price, because their demand will increase, their price will increase, which means they can afford to offer a lower yield, because price and interest rates always move in the opposite direction. And this is why you get what you get here. That during crisis, that gap between the corporate yield, and the government bond becomes very large. Are we clear about these things? Good, good. So what are we doing next then? We've covered that. I want to look at some very weird yield curves now, which the book will not cover. I want you to tell me what you think of them. This is UK yield curve, 7th of February 2009. And if you look at the Eurozone, you get this. And if you look at the US, it's bloody normal again, isn't it? But fine, okay. So let's look at this. I mean, what you get is, in the US, you get a normal yield curve, what we call the smoothly upward sloping yield curve. Can you see that? But if you look at Europe and the UK, whoops, you get an S-shaped yield curve. Can you see that? And this is something that I don't think the book covers, but I want you to know, because we're saying here all the things that can affect the yield curves, regardless of what. It's not just about the two obvious things, economic activity and inflation and risk. I mean, there's much more than that. As I said, I discussed about convergence. I'm going to discuss something different here. Because you see, what happens here is this. If you look, let's forget the US, because the US looks normal. I mean, I'll tell you what. Let's start from the US, because that makes more sense. It says, the latest is the red line. The dotted line is a snapshot a week ago. And the grey line is when things were really grey, and it's a month ago. Now, we are in 2009. We've hit the zero lower bound. Do you remember that? That the interest rates were about zero. And you can see now the US is offering around zero. And what they expect to do is they expect these to carry on for some time to be around zero. But then they start their QE and they get more and more optimistic. And what you see here is that their line shifts within a week, and within a month it's even higher. So they start offering high interest rates because they know the economy will be coming out of the recession. In the meantime, back in the UK, there's a little bit of uncertainty here. For example, we start with the latest, or should we start with a month ago, which is the grey line, and it's the opposite of the US. Every revision is a little bit more pessimistic here. So instead of the line going up, the line gets a little bit flatter, and then the red line gets around 1% or just below. And then they say, you know, from half a year from now, that will pick up. So you can see that there's a little bit of skepticism there, and the revisions are not very positive. But what happens is the UK also is doing QE. And the truth is, if you look at the later yields, they pick up. In the meantime, if you look at Eurozone, well, this is what the tragedy is, you see, because the revisions are very bad. So, for example, the first revisions are, look, we're doing fine, it will be 1.50, sure, within a week. No, it's not, the rates will have to stay low. We're trying all these different policies without QE, of course. And the revisions are dramatic. And in the end, what happens, at some point, they start offering even negative rates. So the revisions are really, we're not going anywhere out of this crisis. So that's that. And at some point here, the 3 and the 6 month bills actually were offering negative rates. And what's interesting is that even the interest on reserves, this is what the central bank pays commercial banks to keep their money with the central bank. Even that became negative. In other words, what they were trying to say in Europe is that if you keep your money and you not use it, if you don't use it to boost the economy, we'll penalize you. We'll come to this in a later lecture. But if we all understand this, what the revisions mean, it's all about expectations and what happens in the markets, what the markets think really. But then, fine, there's another problem here, however, which is the S-shaped yield curve. I'm sure you get this, what I'm talking about, and this, particularly for the Eurozone, which was a mess at the time. But what about the S-shaped? I mean, what about this bit here? So what do you think is happening there? I mean, what's happening there, it's something that probably your parents will remember dearly, and something that will affect you as well, which is basically the whole structure of pensions started changing. The whole structure of pensions started changing. Why? Because of the crisis in the financial markets. I mean, the financial markets, I mean, what pension companies do is invest on different assets so they can give you a nice deal when you reach 65 or whatever. But if the financial markets are doomed, then you can't really pay back the money that you think you promised that you'd be paying back to pensioners. And this is when, pensions went down, but at the same time, insurance companies and pensions had to rethink of what to do. And what you observe in Europe in particular, and the UK, is exactly that. Remember, the governments are offering bonds, right? Big quantities of bonds to finance the deficit, right? So the supply of bonds is really big. But what happens is, particularly the UK and the European governments are issuing long-term bonds here. In other words, 2030, because they know there's not much point in putting a lot of bonds of very short maturity out there. Why? Because they know this crisis is going to last. So there's no way that they'll be paying back the debt within 2 or 3 years. So you can see that most of the debt is coming out on 20, 30-year bonds, you know. Yeah? So, at the same time, a number of financial institutions, particularly dealing with pension funds and all that, are trying to find long-term safe investments. So they switch to these bonds that come out now, and the demand for them is crazy. You understand why? Because they want to make sure they get these safe bonds into a very uncertain future in the middle of the financial crisis. So what happens is there's an excess demand for the 20 to 30-year bond. What do you expect this to do? The price will go up. But since we're talking about yields, what's it going to do to the yields? Exactly. The yields will go down now. And this is what you're picking up here. And as I said, because the book will not explain these things, and I think they're very important, what you observe therefore there is now an excess demand for these long-term bonds by institutions and pension funds. So, as most of the bonds are issued for 10, 15, 20 years, that excess demand starts dipping the yield curve because the interest rate they offer on them now gets lower and lower because of their high demand. Are we clear about this? Yeah? Good. Very good. So, let's summarize a few things, then we're going to have a break, and then we're going to go into the theories. You see, what I do usually is I do theory, and then I look at what's happening in the real world, but I'm sure you've realized that for the last hour, I'm talking what's happening in the real world, and then I'm going to go into theories to see how economists have been trying to explain these things. So, not that the academic world is not a real world, of course, yeah? But we like to put theories behind things, and you'll see why. So let's summarize some main facts that we've observed about these yield curves. First one, fact one, is that yield curves will move together over time. In other words, if something happens in the economy and I revise my expectations about what these bonds should be offering, and then again, if you look at the demand supply of them, that will actually determine what's happening, you will see that they move together. See, the revisions usually, it's almost like a parallel shift with a bit of a spread. That was highly unusual, these crossing graphs, which means that the revisions are very pessimistic. I repeat, yeah? But usually what you expect to see is that yield curves move together over time, up, down. The second one is that when short-term interest rates are low, yield curves slope upwards, and when interest rates are high, the yield curves will slope down. I mean, again, are they high or low here? The short-term rates? They're low. Therefore, you expect them to go high. But if they're very high today, very high, and you expect a recession to be coming in because the economy is going through the business cycle, if they're very, very high, then you would expect them to dip down a bit during a recession. Remember the first graphs we saw, it was dipping and then up again. So if they're very high, you expect the midterm, let's say, rates to be lower. And of course, that goes back to something that Keynes used to say about the normal rate. We'll cover that. Fine. Fact three, almost always, but not always, almost always, yield curves are positive sloping. But they can also be negative sloping, which is what we call inverted, or flat. But when you look at the very, very long-term structure, in other words, the 50-year bond, usually you would expect them to be upward sloping, right? Now, if you look at the 10-year, it may not be. But if you look at very long-term maturities, then you would expect them to be almost always positive sloping. And the fact four that we've looked at is that on the same date, because these are snapshots we said, right? On a particular date, so on the same date, yield curves of similar maturities, but of different enterprises or different countries, as we've seen, they can be very different because they may account for risk and other demand-supply conditions, but also other economic conditions you may have about information, about a crisis, about a particular country going into a crisis, and all sorts of other such things. Right, so these are the main facts. So what I'll say next is have a break, but before I say that, is you've got to know these facts, right? Because any theory we do must match these facts, right? This is how we're going to say if a theory is good or not. We'll be looking at the facts and we'll say, does it satisfy F1, F2, F3? So that's what we'll do next. So have a little break, 5 minutes, and then we'll carry on.
So I've done research last week.
Yeah.
You're right about the Japan's economy. I think the series is it's not the collapse of the Japan economy.
No,
Yeah,
you said that.
Liability.
Yeah. Yeah, I mean, I never said it was because, I mean, you said that. You said it's been collapsed forever. It's not. The economy's fine. What Japan has to do is they have a big issue with pensions. They have an over-aging population, and this is why they've been trapped in this. And they rely a lot on government bonds to get out of that trap.
So you're saying monetary policy is more effective than?
Sorry?
So you're saying that the monetary policy is more effective than?
More effective? Look, I mean, the Japanese economy is not problematic at all. You know, there's no problems with it. I mean, I don't see a problem with it. Once upon a time we thought it was almost zero inflation, there was no economic activity. They're fine now. They're not China, but they're fine. You see, when you run an economy like Japan, it's quite steady.
Yeah.
Economies like China, for example, who are flying now, they're very different. But when they fall, the Chinese will fall from very high. As the demand drops for their goods, the Japanese are sort of in a steady state right now. Right, let's take some more questions because this is fun.
I was wondering, you know what time for the tutorials? I might not be able to send today's tutorial. What one time for 5 p.m. Is there an earlier one?
The 5 p.m.
The tutorials for today.
Yeah.
It's like
Yeah. It's 5 to 6.
Is there an earlier one?
Is there another one?
Is there an earlier one? Any chance?
No, I wish there was. I hate it as well.
I can't help.
But listen, I mean, you've all been assigned tutorials because the class is oversubscribed and you can't move around the tutorials.
It's more like just for today's one.
Oh, just for today's? No, there's only one. That one, I'm afraid. I wish that we didn't have it either, but 5 to 6, not a good time on a Friday. I mean, but there you go.
Yeah, I just wanted to say, I think we've been given like access on the platform that we shouldn't be given because we can see like assessment, for example. That would be
Assessments for when?
for the end of the semester
For this year?
for this like module.
Mm.
Yeah,
You mean the exam last year's or this year's?
this year.
Okay, this is important. You have to send me something.
Okay,
Yeah, can you send the link?
I'll send you that.
Because that's very important.
I'm sorry, I didn't really hear correctly, or I don't know the word, but you use the word, for example, UK is more pessimistic, everything, but UK is also doing QI, QE. What is that?
It's quantitative easing.
Quantity. Okay, thank you. I don't really define it. And also, I'm from Lithuania, so like my English is still.
No,
not
it's
that
very good. It's very good.
Okay.
So yes, please send me a link. Because
Yeah,
that's
should I
very
email it to you now?
Please.
I haven't looked into it, but I know, it says like this folder should appear on this day, but it's appeared already. I haven't clicked onto it, but I'm guessing like it shouldn't be there. There's a few other things that are there. Should I show you?
Yeah, please.
Yeah.
Please show me now.
It's a bit weird. Maybe I'll tell you.
simply, this country is not exporting very much. Europe is not exporting apart from 1 or 2 countries. Japan is not exporting because everything's being exported by China, who's quite protective. All that will change. I mean, I personally believe that Trump, for example, was voted with that in mind, that he's going to put tariffs and he's going to be tough. And, you know, but of course, you know, anyway, I have to start now, so we'll talk about it. Right, so shall we start? Okay, so let's very briefly, and you can read more about this, main uses of government bond yield curves. They're used as leading indicators of economic activity and conditions. You understand that, we've just been discussing this, so you can look at them and see what the market is expecting. But we can also use them in economics for forecasting. In fact, yields, for those who are doing econometrics, have been used as leading indicators in GMM models, as instrumental variables in other models, because they can be used as leading indicators, right? So they can be used as a benchmark for pricing other fixed incomes, and you understand that as well. For example, if a 10-year government bond in the UK is 5%, you can't have a corporation coming in and say, I'm going to give you 3%, because you might say, okay, well, I'll take 5 from the government, thank you very much, which is safer. So, they will have to adjust the prices, and they use this benchmark for pricing other fixed income securities. And of course, they can be used to boost returns in bond investment strategies in the corporate world. Remember, corporations hold a number of bonds as a safe asset. And they can do all sorts of things. For example, they can use strategies like the riding the yield curve, depending on the rates and the maturities, or rolling down the yield curves. You can read about these things. I mean, just to give you one, is that let's say that in January next year, you expect to pay back your shareholders some money. Well, you may want to take bond maturities that they mature just before then, so you can show a higher payback. All sorts of little things they can do. But we don't want to do that now. You can read more about that. What I'll say is that the 3 main theories of the term structure of interest rates, and this is the segmental markets theory, the expectations theory, and the preferred habitat and liquidity theory. Sounds like we're in some desert island, with the wind coming in. Very nice. Right. So, okay, so these are the 3 theories. But before we look at these 3 theories, let me remind you 2 concepts that I'm sure as economists final year you will know about. The one is substitutability of assets, and the other one is risk aversion of investors. Substitutability is how you perceive short-term investment to long-term investment. So, for example, if I have £1,000 to invest, I can decide whether I want to buy, and I've got it available, let's say, for 5 years, right? I can decide whether I want to go straight away and buy the 5-year bond, or split it into 1-year bond, then another 1-year bond, then one, So I can decide whether I want to go for very short-term bond investment, 1 year, or 2 years in a 3-year, or directly 5-year. But that depends on my substitutability of assets. In other words, how I perceive the 2, short-term investment and long-term investment, as substitutes. I mean, do I care, or do I just want a 5-year and then not deal with it until 5 years later? Right? On the other hand, there's something called risk aversion of investors, and you understand that. If I'm a risk-averse individual, like we think that most people are risk-averse, although I don't think everyone is, but what I'm saying is that most people, the average person, would like to think in economics that they're risk-averse. Are you with me? That means you want to see a higher yield, a high interest rate, for less liquidity, for an asset that matures in the future, or if you put your money into a fixed investment for 2 years or 3 years, you will want to see a high interest rate than something which is a deposit rate that you can take your money tomorrow. Why? Because you don't know. I mean, you might need this money, right? Or you know, if you invest in assets, you don't know what may happen in 5 or 10 years from now. So if you're risk averse, you will want to see a higher rate. If you're risk neutral, you don't care whether it's a 5-year bond or a 1-year bond. Give me the same return and I'll be happy. Right? So I don't care if I reinvest every year in 1-year bond or if I go and get the 5-year bond. I will want to see the same return at the end of the day, and I'm happy with that. That's the risk neutral. And of course, there's the risk lover, which we're not going to discuss here, because I don't want to encourage my students to do silly things, right? This is when you go out there and you start spending your money on risky assets and equity, and then you lose it all. Maybe. Fine. So let's start. The segmented markets theory, what is the main assumption or the rationale? They assume that bonds of different maturities are not substitutes. So, you know, if you've got investors, they will want to deal in a particular market, the 5-year, the 10-year, the 20-year. Now, they also assume the A stands for assumption. The second assumption is that investors have strong preferences for bonds of particular maturities, as I said. So markets really are segmented according to maturity. That's why the theory is called segmented markets theory. So let me put a nice diagram. Oh, the third one is, of course, investors prefer less risk. They're risk averse. Which means what? They will want to see a higher interest rate for longer maturities. If I put all these three together, oh, I forgot another one. Assumption 4, which really, it's implied that investors avoid transaction costs. You don't need that one if you assume the other 3. But this is to justify why they're segmented in one market. Are you with me? So for example, they want to avoid changing the maturities all the time because there's a transaction cost involved. Right. Okay, so you can see now they absolutely make clear they don't want to move from their markets. There's transaction costs, which nowadays there isn't, but back then there was. Right? You had to talk to your broker and all that. Now you can do it as we talk. Investors prefer less risk. Investors have strong preferences. Fine. Okay. So if you put all that together, you come to this nice diagram, which again is not in the book, but I thought it would be nice to put this diagram so I can show you what happens. Now, usually we have prices here. Guys, do not confuse that, please. Usually we have prices here and quantity of bonds here, correct? But this particular theory wants interest rates on this side. Therefore, this will not be the demand for bonds. That would be the demand for bonds. But if you want to call this demand, call it demand for loanable funds. Right? Who's the demand for loanable funds? Yeah, they could be. It's the supply of bonds. The ones who demand loans or funding. But they call it demand so they can please us economists as well, you know? Demand for loanable funds, which is the supply of bonds, basically. You understand here what's happening, right? I've got the interest rates on this axis, which means that my demand for bond now has become this. Or the demand for loans or loanable funds is this. And the supply of loanable funds is the demand for bonds. Does that make sense? Yep. It's a bit confusing, but think of it, as I said, we have interest rate here, not prices. So because interest rates and prices are inversely related, we flipped over completely the diagram. Therefore, if I had to denote this, that would be the supply of bonds, and that would be the demand for bonds. But I call it demand for loanable funds and supply of loanable funds. Fine. So basically what this theory says is that I've got three markets, let's say the 1 year, the 6 year and the 12 year, and I can come directly in there, and the demand and supply of these markets will determine an interest rate. There it is, the 6%. Can you see that? This one interacts a bit higher. So if you want to use this diagram, make sure that it does interact a bit higher than the shorter maturity. Why? Because they're risk averse. So they will not accept for a longer maturity a lower interest rate. Are we clear about that? Okay. So this one interacts at a higher rate here at 8%, and this one at even higher. This is the 12-year, and it interacts at the 10% rate. So that's the segmental markets theory. There's no substitutability of assets. You go directly to the market that you want, the 1 year, the 6 year, or the 12 year. You have a demand, there is a supply of these particular maturities, and everyone is happy. And therefore, if I now plot maturity here, 1, 6, 12, from the three interactions I have here, 1 at the 6%, the 8, and I have my upward sloping yield curve. That's one theory. So you may say, what's wrong with that theory? Why don't we stop here? It sounds good, yeah? Well, this is the problem. Let's say that something happens in a particular market, the 6 year. There's an excess demand for loanable funds. Therefore, that will shift out there, and that will put the interest rate to 9%. Does that affect the 1 year and the 12 year? No. This is something specific to the 6 year market, correct? Correct. Therefore, when I come to plot this, I will get a little blip at the 6 year. Can you see that? And imagine now you've got many markets and you only see a little blip in one. Did you see any yield curves like that? We said yield curves move up or down together. They move together. It's not just one market goes up and there's nothing else. Therefore, this is where these guys failed, right? It may explain fact 3 and 4, which is about risk aversion, about the interest rates, but the segmental markets theory cannot explain fact F1 and F2. And if you go back, you will see what they are. There they are, the facts. It might explain, it will not explain that yield curves move together over time, and when short interest rates are low, you expect them to be going up. No, because it's specific to what happens in that market. Fine. So, not a very good theory. You might say, why are you doing it to us then? There's a reason why. Because that was one of the first theories that explained risk aversion and the fact that you want to have a high interest rate, and we'll use this theory in a minute. Fine. So, we've done all that. The segmental markets theory is also powerless in forecasting. I mean, for us guys, it's absolutely powerless. Because if I observe something in one market, it doesn't tell me anything about the rest of the markets. Therefore, I cannot use them to forecast what's going to happen to the rest of the financial markets. Fine. So let's move on to a more useful theory, which is the expectations theory. That goes back to Ian Fisher Hicks, who was here. And the main assumptions here are, first of all, investors are risk neutral. So you can see where they go now. Short and longer term assets are perfect substitutes. So there's perfect substitutability between maturities. And there's no transaction cost. See, what these guys are doing are quite clever, actually, because they're removing all the information about risk neutrality, because they can add that as a premium later on. They remove also transaction costs. Why? Because they want people, they want investors to move freely from one market to another. Okay? And this is what happens. This is what happens. They want investors to move in and out of markets only because they're trying to show that there's a perfect substitutability between longer term assets and perfect substitutes. So let me give you an example. Expectations theory shows that longer term rates are an average of expected short term rates. So based on these assumptions, I've said, decisions depend basically merely on the final income they will receive. So they don't care about transaction costs. They say, look, I don't care whether I'm going to the long or the short run. All I want to see is at least the same return between the two, and I will decide which one is best. So the whole assumption about this is that they start from the value of the short-term investment must be equal to the value of the long-term investment. Right? And this is really what they use. Let's say that on a specific day you've got £1,000. In fact, whether you've got 1,000 or 10,000 or 100,000, it makes no difference. Why? Because you will still make a rational decision here where you want the money. So, but the important thing is this, that on this day the 1-year bond is 6% and the 2-year bond is 6.5. Subscript number equals maturity. So what you see here is the 2-year rate and this is the 1-year rate. So I've got a choice here. I either buy a 1-year bond rate today and then I get my money and I reinvest my money into another 1-year bond in the following year, or I go directly to the 2-year bond and say, can I have a 2-year bond rate? And I don't deal with investing or anything anymore. I'll just wait for 2 years to get my money. So this theory begins from here, that if I start with a long value of being 1,000, 1 plus, because this is the gross interest rate you will receive, if, what was it? If the rate on the 2-year 6.5, I will receive 1,134. Alternatively, I can reinvest in 2 1-year bonds, as I said, exactly by the same amount. And the assumption here is that you reinvest everything, even the interest payment, so you get the compound interest payment. So I have my £1,000 times the 6%. Can you see that? So this one here, 1, if I take 1,000 out, is 1 plus the 6%. Okay, I know that because I will be given that. But then I'm going to reinvest all that to another gross interest payment of the 1 plus the expected interest rates of the 1 year in the following period, the T plus 1 in the second period. Are we happy with that? So that's what you do. If you expect the interest rate in the following period, because you don't know that, this is an expectation now. I mean, you decided to go for the 1 year, but you had a choice. You could have got the 2 year that you know the rate, or you buy the 1 year, which you know the rate today, but you don't know what the rate will be tomorrow, right? In the next period, in other words. So if the expected 1 year rate in the following period is 8%, then this is what you're going to get. You're going to get that from the short-term investment, you get 1,144, which is slightly bigger than if you had the 2-year bond. If, of course, it's 6%, then what you will get is that you will get 1,123, which is less than the long-term rate. So that depends on your expectations now. And what I'll say here you might find strange, but that's how we think. Economists are strange people. We use rational expectations here. Rational expectations, everyone is perfect. Yeah? Everyone thinks rationally. And no one has more information than another one. We like to do that to understand how the world would work, and then we can put the imperfections in. So if we do that, I can tell you these guys, if I had rational expectations, and if I had the information that I need to make decisions, then the answer is this. For the two markets to exist, the rates must be the same. Do you understand that? In other words, the final income must be the same. Why? Because rational agents will make sure the one market doesn't exist if it gives them less. So the whole theory builds on this assumption that due to arbitrage, that, you know, I can see the information and therefore I'm going to go to the short rate because they offer more. The other market would not exist that long. They will all go for the short rates. Okay? If they thought that the long rates are more profitable, they will all go for the long, but the short rate will not exist. Therefore, the fact that we have both short and long-term rates, it means that they must offer more or less the same value. That's the idea. So they start from this equation that the two must be the same. Therefore, I can use this now to build up a formula. If I do this, I'm putting my 2-year investment here. I'm putting my 1 year plus 1 year in the next period here. I can get rid of the sum. It doesn't matter whether you've got 1,000 or 100,000. So I can get rid of that as a common factor. And I'm left with this. And then, based on 2, we can write the general formula. Because equation 2 is only for 2 periods. Now imagine that you extend this to n periods. Okay? If you extend this to n periods, you will have this. And I can assure you that if you solve for the IN here, in other words, you take the power on the other side, so you have the root to the power of n, minus 1 because you have 1 as well here. Yep. And the 1's outside, of course, the root, because it's all to the power of n. So if I write it like this, to find out what should be the n period yield, then I'm left with this equation here. But this equation can be approximated to this. And if you don't believe me, don't do it now. Sit home. If you've got some time, make some cup of tea and just go through this. And you will see that this formula here is almost identical to this. Okay? But what does that say? That if I'm a rational agent, and I believe in the expectations theory, that we all take expectations more or less in the same way, then the bond rate offered on the n period maturity should be equal to the rate that I can see today, and then all the expected rates of one period in the following period, and the period after that, and the period after that, divided by n. So you take an average of, I repeat, you take an average of the current rate and all the expected rates you think you'll be getting in the one period rates, and then you take an average of that, and that is really what the n-year bond is. So 5 is used by the strict expectations theory to explain the term structure. It can estimate the rate that must be offered on a bond of n years for the risk-neutral investor to hold this bond. It can determine the shape of the yield curve. All of that is true. And here it is, an example. Okay? So for example, the 2-year bond is today's current rate on the 1-year rate plus the expected 1-year rate in the following period, the T+1 period. If this is 8%, that will give me 7%, so that will be high. If that is 5%, let's say, or whatever, then the yield curve will be downward sloping. And if it's the same, in other words, if this is 6% and this is 6%, 6 plus 6, 12 divided by 2 is 6. Therefore, we'll have 6% here plus 6%. It will be a flat line. So you get the picture now how they think, which is very, very useful. There's a problem, however, with this. And the problem is, so basically, If short-term rates are expected to rise, an upward sloping yield curve. If they expect to fall, you get a downward sloping yield curve. And if you expect them to remain constant, you will get a flat yield curve. Now, the thing is this. The expectations theory can explain fact one. That if something happens to one rate, that has a domino effect on all rates. Therefore, you will see these lines move together, as we've seen in reality. Okay, so that's good then. Expectations theory can explain fact two, that low current short-term rates will be expected to rise in the future. Yes, I can see that again, because if this is very low, and this is expected to be higher in the future, I can see why this will be upward sloping. Or the opposite. If today they're very, very high, I will expect them at some point to drop if we have a boom, you know. Fine, okay, so that's good. But what is the problem? Expectations theory can partially explain F3. In other words, remember what F3 was, because this is important. That almost always yield curves are upward sloping. So what's the problem here then? Well, I mean, sometimes they can be upward sloping, sometimes they can be negative, according to the expectations theory. But there is a problem here. And I'll tell you what the problem is. That on average, you would expect the yield curves to be flat. Why is that? Anyone? True, but I want more specific things. I mean, you can have a massive recession and a very small boom, so that would not be the case. Anyone? Why would be the same? I mean, from your statistics, you know about normal distribution, correct? What's the expected mean of a normal distribution? 0. In other words, these are rational expectations, guys. They say that, you know, these are normal agents with normal distributions. There's a massive population, they all think the same. But the expected mean of a shock is 0. I mean, what I'm saying is, they have just as much reason to believe the rates will go up as much as to go down. They have no reason, they have no bias. The expected mean is 0, right? Because they're rational agents. Therefore, if they had this information that things will be going up, then they would have taken it into account. So they all act the same, but they have no reason to believe there's a bias. There's an upward bias or a downward bias. Therefore, on average, you'd expect rational agents and expectations theory not to expect a change. I mean, do you have a reason to expect rates to go up or down? So, that's part of the problem of the expectations theory. The other one is, it fails to explain fact 4, that the rates usually go up. But this is related, guys. I mean, this point here is related to this. Because if they didn't have a risk-neutral agent, they would still get, even with rational expectations, they would still get, even with a mean 0 in other words, they would still get an upward sloping yield curve. Why? Because if they were risk averse, they would say, I want to see for a higher rate, for a high maturity, a higher rate. So they will get that. But they assumed risk neutrality. In reality, longer rates seem to underreact to changes in the short-term rate. So that brings us to the final theory, which is the preferred habitat or the liquidity premium theories. Okay? And it's very simple, guys. The rationale here is that it combines the segmental markets theory, and that's why we wanted to do it, with the expectations theory. In other words, it takes the two good things from the segmental markets theory, that there should be a premium for longer maturity. But then the rest is really driven by the expectations theory. And that's the best theory we have today. The idea is this. You might say, why do you call it preferred habitat or liquidity? I mean, are they the same theories? No, they came at different times out, and initially it was called preferred habitat because it was the idea of, the location matters. Of course, when you hear location, think of markets, financial markets. So the location of the market, whether it's a 2, 3, 5, 10 year, it matters. That's why it's called the preferred habitat. The idea was, if I was offered a lectureship in another university, in Siberia, let's say, for example, with the same wage, God, I mean, why would I do that to myself? You know what I'm saying? You've got a preference for a location. And that's the idea here, that given a preference for a location, I've got to have a premium. So if Siberia got back to me and said, you know what, we'll give you $1 million for a year. Do you want to come? Oh, I might risk it, I don't know. That's the idea here. And this is what happens with the locality of the financial markets. That's what it's a preferred habitat. That, you've got preferences for the location of the market, but you're happy to move to a different market that you don't prefer if you give me a higher premium, a higher rate, to account for that risk. So this is what, but then it became liquidity premium theory, which is how we know it today, because the theory starts switching to the idea of liquidity instead of the locality, because really, locality and liquidity are the same thing here. We're talking about locality of different maturities. But of course, the longer is the maturity of the market, the less liquid it is, correct? So the idea was the more liquid is the market, you like to see a lower rate. You would accept a lower rate. But the more illiquid it becomes, the longer is the maturity, in other words, you'd like to see a high rate. Put them together, and that's what you get. You get, this is what I've just explained, this is what you get. If I cover this thing here, I will be left with this, that the interest rate on the N-year bond will be determined by that market. Can you see that the premium here is N? So the theta N will be increasing with the N, with the maturity. And that's exactly what segmented markets theory says, that, depending on the locality of the maturity, you'll be increasing the interaction of the rate. On the other hand, if I cover this, well, I mean, if I cover this, what do I get? I get exactly this, which is the expectations theory. So you can see that the whole liquidity premium theory, it's driven by the expectations theory plus the premium to do with the segmented markets, the premium of the maturity. Okay? Implication, long-term interest rates will equal the average of short-term rates plus a term premium. So basically you've got the expectations theory plus the premium that comes from the segmented markets theory. Now, what does that mean? Let's take the example that I took before. Let's cover this premium here for the 2 year. I mean, for the 1 year, there's no premium, of course, right? But let's say for the 2 year is 1% the premium. Let's cover this completely. And I'm looking at the expectations theory. Let's say the expectation says 6% here, and I expect the 1 year in the following period to be again 6%. What will the expectations theory give me? 6%. But if I add the premium, and if I keep adding the premium for maturity, you will see that it will start going up. So, the liquidity premium theory implies an upward sloping yield curve, whereas under expectations theory, the yield curve remains flat. So what is the comment? What's the criticism of this theory? I mean, can we explain yield curves perfectly then? Well, we can never explain anything perfectly in economics, so get used to it. I mean, you're finalists. I don't want to be telling you lies. We most of the time get it right. But it's a very difficult science because it depends very much on psychology and news coming in all the time. I remember Her Majesty, Queen, when she visited the London School of Economics straight after the crisis, and Professor Layard was there, and some other professors, and you know, she was shaking hands. I said, "How come you didn't see that crisis coming?" And I think it was Professor Layard said, "But that's what we say, the shock, ma'am. I mean, this is the economic shock. And why couldn't you see? Well, it's a shock. If we could see the shock, then it wouldn't be a shock, would it?" You know, and that's the problem with economics, that there's all sorts of things happening, and what you observe is that, yeah, I mean, both the preferred habitat theory and the liquidity premium theory can account for most of the facts that we've observed in real life, but the spreads are not always there, because we said the spreads are not just about the interest rates. They account for other things which are not always captured up to last minute in the interest rates. It could be, as I said, we said convergence, risk, all sorts of other things, demand, political events. So that's a good point to stop, I think. Right, guys, any questions? No. I've got a class, I think, 5 to 6, lucky you and me. But I'll see you next week now. Yep. Hi.
How are you?
Yeah, how are you?
I'm good.
So tell me,
Yes.
so, I mean, what I was thinking is, there have been many mistakes with admin. I mean, somebody else showed me another mistake. I think...
So it's just that it'll be very hard for me to find a 10
Yeah, I know.
now. And I really
It-
love you know what, I took health economics just so I could take a 10 credit module of
Yeah.
this.
I mean, the thing is this, that literally, I mean, by the book, you're not supposed to be here. Nobody else has come with that problem, so I don't know what happened that day. Because I asked the students in the class as well, and yeah. So, no, don't say anything for the time being. And if they ask you, I will say that I've given you permission to join. Okay? Is that okay? Yeah. Okay, it's just I wanted to make sure that... that you're happy with it, that this is what I want to see. You know, you're happy with the level of difficulty. I mean, it's not very difficult, but...
Yeah.
Yep.
Because it's the first finance module I have, but it's just that I want to work at banks, and you cannot go over equity and bonds without, you know.
Equity, we say we're not going to cover because
Yeah, I
it's
know,
not
I know,
corporate,
because
but
I had
Yep.
a module that did. Also, I don't want to ask something about today's lecture. It's just that we know that the ET assumes that there's difference between short-term and long-term interest rates due to expectation of future short-term investments, right?
they expect the same to be the same. Yeah, they expect both to be the same. They work on that basis. And the thing is that because they're rational agents and they all have the same bit of information, no one knows whether the rates will go up or down. So on average, they don't expect to change.
Okay, but exactly what? So premium is not constant, but how does this cater to that then? Because the premium, the risk premium.
But this is what we said. There's no premium in the expectations theory.
Okay, all right.
Are you talking about the ET, or I thought you said ET?
Yes.
ET doesn't have a premium.
Yeah, so it assumes that the difference between preferences is only because of the expectation.
I just wanted to ask a question.
Yeah.
You know when you were saying the change in
Yeah.
going to show zones
Yeah,
risk
yeah.
of competition.
And human behavior, of course.
Human
Yeah.
behavior.
Yeah.
And then when you went onto shows, we looked at the Eurozone, right, and the financial crisis. I got a bit confused with how they're not economic activity.
They are.
They are.
They are. But you see, for example, you look at the the spreads before the crisis, yeah,
Yeah.
and you can see everyone's the same. And then following the crisis, with the fact that Greece may default and walk out of the eurozone, they want a big spread. The investors want to see a very high interest rate, but of course that doesn't happen. I mean, Greece doesn't walk out of the eurozone in the end, and within a day, it's dropped back to. It's nothing to do with economic activities, with expectations of potential news, political events. Nothing to do with economic activity.
Oh, okay, yeah.
Nothing. I
General,
mean,
yeah.
the economic activity was as normal at the time.
Okay, so what
I mean, look, from day 1 to 2, economic activity does not change. I mean, you might get a little, but you can see the rate dropping within a year, which
Yeah.
means expectations about political events, about not leaving the eurozone. There's all sorts of things that nothing to
the
do with
news and shocks that
Yeah.
we talked
Yeah.
So is that what related to like the I just got like in my head the competition and
The competition is, that one bond may be more competitive to another.
so is that why in the when you were saying we don't explain everything correctly right at the start
Yeah.
in the US when they revised their yield curve it was straight from the bottom
Exactly.
but with London it's still at
Yeah,
the dip.
London,
Is that purely competitive
yeah, it's not competitive. It's that London and the eurozone in particular, but London was coming a little bit. It was coming out of the crisis a little bit later than the US.
right
So they revise, it goes down and then up,
okay
but a little bit later on, their normal curves as well. It's the eurozone that carries on with all these crosses,
yeah
which means, as I say, it's not economic activity. It's just they're getting it wrong in terms of monetary policy.
sorry I know it's really at the end of the day but when we've seen the S curve
Yeah.
and you was like right here is because of the pension schemes
Yeah,
the change in pension schemes but like how did they know 15 years before that in 15 years time there was going to be a pension scheme change that would affect it how did I read
I
that
think you
wrong
got this wrong.
Yeah.
Completely. If you go to the market now, you can buy a 20-year bond.
yeah
You don't have to wait. So you're asking me, how do they know what's going to happen in 20 years?
because when they predicted the yield curve right
Yeah.
so like how did they predict it was going to in 15 years go
But
like
that's
that?
not a prediction. The yield curve is not a prediction.
Okay.
We look at it. It's what the markets want.
so
So I was saying, this is not even to do with predictions of economic activity. It's
Right.
demand, purely demand for bonds of that maturity because they came out in big bulk. Because you're trying to cover the deficit. So as institutions, in particular pension funds, really went for these bonds, their demand shot up and the rates came down. But these are actual demand and supply.
oh, so this is what actually happened
Yeah,
right?
yeah.
That's what I thought but then I
mean,
got
all I'm
confused
saying is that you can look at the bond and you can predict, we're going to be out, the markets predict that within 1 year from now,
yeah
the curve will be going up
Right.
instead of down. But that's not prediction, this is what
but what
happened.
were you looking at is what's actually happening
And this is why I said it's not always about economic activity. Many things depend on political events, random events as well, shocks and energy
Yeah, yeah.
prices going up, but also demand supply actually doing it.
So why I thought it was predicted was because when it was 3 different curves that were revised, like the latest, I can't remember the
Yeah,
time
yeah.
figures of it.
Month ago.
So like, was that like today? Did that mean today? Like I didn't understand.
Yeah, so no, basically
Like when
the
was the
one
few minutes before?
I've come up.
No, it's cool.
Basically, the one that says now is what's happening now.
Right.
The month ago or a week ago
Oh,
is
yeah.
like a snapshot. If you took a picture of the markets of the yield curves on that day, this is what you'd see.
Right. Right.
Yeah, but it's a snapshot. I mean, that's what.
Yeah. I got confused. I thought it was from the
And you
start.
can no,
Yeah.
and you can see the fact that it's going down or up. It means that they've adjusted the revised expectations
Yeah.
of what's going to happen. And the markets, have a high demand or a lower demand for that particular maturity.
Thank you very much. Appreciate that.
I think the English guys.